I was in the gym this morning, and while I was there was a few guys in the locker room that were talking about making some easy money. A couple of them were talking about how they wish they would have bet on the last UFC fight because it would have been easy money. Then one of the guys says that I can't wait until my crypto pops off because then I'll finally be able to retire and not have to worry about money anymore. At this point, I had to really bite my tongue. Not because there's no value in crypto or the blockchain, but because there's a much simpler way to build real wealth and not have to worry about money without the gamble. Because throwing your money into some random cryptocurrencies, throwing your money into a random sports betting, whether it's UFC or NFL or NBA, these are gambling. And you're the person that's making these companies rich, when in reality, there's a much simpler way for you to get rich. That's why today I'm gonna show you a boring way to build wealth that's gonna take less headache, less stress, less risk, less work. You can automate the process in 5 steps, and now you won't have to worry about trying to guess if the Lions are gonna win the Super Bowl, because they are gonna win the Super Bowl this year. The 5 steps to make this happen are: number 1, get some money. Once you get that money, number 2, systemize that money. You'll see what I mean by this. Number 3, now build a money growth strategy. I'm gonna go over specific examples of how you can grow your money. That way you're not left wondering, what do I actually do? Where do I invest? I'm gonna show you how to do that. Number 4, ride the storm, because there are going to be storms when you invest your money. And number 5, how do you then scale your wealth? That way you can see the bigger returns. So let's start by talking about number 1, getting that money. Your income is going to be the backbone for your financial success and your wealth, because you're gonna use your income smartly to make you rich instead of making everybody else rich. But in order to do that, you have to have some income. You can start your own business, you can start a side hustle, you can work 5 jobs, you can work 1 job. It doesn't really matter. You need some sort of income. Now, the reason why people get screwed up here is because they caught into this idea of, if I just have more money to invest, then I'm gonna get rich. You see this on DraftKings and FanDuel all the time, where they're gonna give you all this free money to get started, because once they can get you hooked, well, now you're in the game. You see this on the stock market because, well, if they can get you hooked, now they can sell you leverage, they can sell you margin. You see this with real estate all the time, with people talking about no money down real estate deals. Just get started, buy my program, and now you can start buying real estate with no money. The reality is, if you want to build wealth, you need money to get started. Everybody's gonna try to sell you something to get started with no money, because most people have no money. But if you want to build wealth, you gotta have some money to invest, because investing and building wealth is all about growing the money that you have. It's not about creating money. It's about taking the money that you have and growing that wealth. Yes, you can accelerate that by using debt, but if you don't know what you're doing, that debt is going to amplify your risk, and it's going to make you in a much bigger financial danger zone. So if you don't have money, the first thing you got to do is go out and get some money, get a job, start a business, start a side hustle, go out and start doing things to make some money. Okay, I'm not going to go over how you can do that in this video, because there are a lot of other things that I want to go over. But once you get the money, the next thing you want to do is systemize this money. So I'm going to wipe this off and show you what I mean. The difference between wealthy people and the majority of people is that when the majority of people make money, they then start to wonder what they should do with this money, versus wealthy people already have a plan in place. So let me ask you a question. If your boss gave you a $1,000 bonus tomorrow, what would you do with that money? Well, you can think about that. And let's make it a little bit more juicy. What if tomorrow, instead of getting a $1,000 bonus from your boss, I write you a check for $1 million? What would you do? Now, I know you're a little bit more financially educated because you're watching this video and you're doing these things to build your financial education, but here's what the majority of people would do. They would make $1 million, and then they would go out, buy a nice home, buy a nice car, go on a few nice vacations, buy some things for their friends, go on some nice fancy dinners, and then realize you have to pay a tax bill, and then realize you have no money left. And then realize you're gonna have to continue funding your expenses in the future, and now you're broke or bankrupt, which is why so many lottery winners end up broke or bankrupt within 5 years of winning the lottery. No more. What every wealthy person do, and what I want you to do from now on, is you're gonna build a plan for your money before you get that money. That way, next time money comes into your bank account, you already know what to do with it. And some of this money is gonna be spent, some of this money is gonna be invested, and some of this money is going to be saved. You want to have this designation in place. That way, then when you go get that money, there's no questions. You're going to have a job for every dollar that you earn. Now, a simple rule of thumb that you can follow is a 75, 15, 10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum that you can invest, 10 cents is the minimum that you save. Now, some of you have been watching my videos for a number of years now, and you've said, Jaspreet, I've been doing the 75-15-10 plan, but I heard you talk about this 50-30-20 plan years ago. I think I'm ready to do that now. Can you talk about that again? What this is if you are ready, well now, guess what? Instead of living off of 75%, you can live off of just 50 cents of every dollar that you earn. And I get it, this is going to be very difficult for many people. But if you can get here, that means you have more money to invest, more money to save. Because the reality is, this is where your wealth is built. Your wealth is not built here with your savings. Your savings here are there to protect you against an emergency. If a kid breaks their arm, if your wife has a problem, if somebody gets sick, if something breaks in your home, you have cash to fall back on so you don't have to go into credit card debt. You want to have somewhere between 3 to 12 months worth of savings. The amount of money that you're going to save is going to depend on your financial situation, how old you are, your financial responsibilities, but somewhere between 3 to 12 months worth of savings. Once you build that savings cushion, now instead of saving more money, you're going to reallocate that money here into your investments. That way now you are investing more money because this is where your wealth is built. Your savings are here to protect you. They're not here to make you rich. Your spending is what funds your food, what funds your home, what funds your car. But the whole idea here is you're always going to have money to invest before you spend all of your money, because this is where your wealth is built. And this is what so many people get wrong. Now the next question is, okay, Jaspreet, I'm going to put money aside, that way I can make myself wealthier. I'm going to put this money aside, that way I can build wealth. But what do I actually do with it? Everybody's making money on DraftKings and FanDuel. Everybody's making money throwing their money into these random places. What do I do with this money, that way I can actually build wealth? And this brings me to part 3, which is knowing your strategy. Now look, I got to give you a disclaimer. I am not a financial advisor. I am just a random guy on YouTube. Everything that I'm going to talk about and everything that I'm going to show you here are for example purposes only. I am not telling you what to invest in. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But when you talk about now your investing strategy, what you have to understand is, what is your goal? Do you want to see growth with your money? Do you want to see cash flow from your money? Do you want to protect your money because you're worried about something? Your goal is going to dictate what you do with your money. So let me go over a few examples of what this means, and then I'll go over specific examples of how you can actually invest your money into this thing. If you were to go out and invest in growth, what that means is now you're going to invest in something that you think is going to go up in value. You want to buy a stock for $100 because you think it's going to go up to $500. That's what growth means. Cash flow means you want to invest in this thing because it's going to pay you money for owning this thing without having to sell it. So you buy this thing for $100 and it's going to pay you, I don't know, $4 a year, a 4% return, but you're getting this every year without you having to sell this investment. And the goal is to buy something that's going to increase how much it pays you year after year after year. That way now you can build an income that you don't have to sell your investment to get. Now, the pro with this is you get to make money without having to sell it. The con with this is when you make money, you got to pay taxes. Here, if this goes up from $100 to $200 to $300 and you don't sell, that's growth that you don't have to pay taxes on until you actually sell. And the second thing you want to understand here from a more of a theoretical perspective is, if this is a company that has this money to pay out, well, if they're giving this money away in the form of a dividend, that's what this is called. A dividend is a cash payment that a company gives you every 3 months, every quarter, for doing nothing except owning that stock. If a company is just giving away this dividend, that means that's money that they're not using to open more stores. That's money that they're not using to hire more employees. That's money that they're not using to grow their brand, to invest in research and development. Whether that's a good or bad thing depends on you. It's good for you as an investor because you get your money. But that also means that theoretically, they're not going to be able to grow as fast because there's less money going into growth. So the companies that are paying out this type of cash flow are generally going to be a little bit more mature and a little bit larger, and they have these big cash profits that they don't know how to invest back into the company, so they're just going to give it away. That's how cash flow works. Protection is now, well, I'm not too worried about the growth of the cash flow. I'm more concerned about the United States economy. So I want to move my money somewhere else, maybe outside the United States, maybe into physical gold, maybe into some other sort of asset where I'm less worried about the growth. I just want to be able to preserve my wealth. Once you start to think about what is your goal as an investor, that's when you can start looking for specific investment ideas. Let's stick with the stock market for the purposes of this video. If you wanted to invest in the stock market, there's a couple of different things that you can do. The first thing is, well, if I want to invest in some company that I think is going to continue growing over time, I could try to find the next Amazon, I could try to find the next Apple, I could try to find the next Tesla. But the problem with that is many times when people go out and try to find a good stock to invest in, they don't know how to analyze the company. They don't really know what they're investing in. They understand the company from a public-facing persona, maybe because you've shopped there, you've seen people talk about this, but you don't actually understand the financials. You don't understand the actual company itself. And so now you buy this company, and then what ends up happening for so many people is the stock starts to go down, you panic, you sell, and you really don't know why you always lose money when you invest your money into these companies. If you can relate to what I'm talking about, you're not alone. And this is where investing in individual companies is great for some people, but for the majority of people, there's an alternative, which is to invest in a fund, whether that's an ETF, which is called an exchange traded fund, an index fund, or a mutual fund, which gives you exposure to a broader basket of companies. Now, instead of investing in one company, you can invest in a group of companies. So let's talk about now, assuming you want to invest in more value types of companies. You want to invest in just the stock market in general. You want to invest in the United States economy because, well, if the stock market goes up, you make money. You just want a simple way to invest your money into the markets without having to find the best company. There are ways to do that. For example, there is an ETF out there called VTI. If you go out into the stock market and you buy one share of this fund, VTI, you're buying a piece of the total stock market. This is a fund created by a company called Vanguard. Vanguard is an institution that creates these types of funds. And if you buy one share of VTI, you're buying a little piece of every company that trades on the United States stock market. It's a simple and easy way for you to invest in the total stock market without having to find the perfect company. Another example is SPY. This is an ETF that gives you exposure to the S&P 500. The S&P 500 is a group of the 500 largest companies on the stock market. This is an ETF created by the company Spider, SPDR, again, an institution that creates these types of funds. And so now, if you just wanted to invest in the larger companies, you can invest into SPY, and now you're getting exposure to the 500 largest companies in the stock market. Now, the nice thing about this is if you invest into this fund, and one of the companies goes bankrupt, well, your whole investment doesn't go bankrupt. The fund will then kick that company out and put another company in. That way, it's more passive on your end, and you're just exposing yourself to the United States stock market, but more particularly, the 500 largest companies in the stock market. How about another example? DIA is an ETF that gives you exposure to the Dow Jones. The Dow Jones is one of the longest and most well-known indexes in the stock market. An index is a group of companies. The Dow Jones is a group of 30 large, well-known, generally blue chip companies. Blue chip means large, established, and well-known companies. And so now if you just want to invest in the Dow Jones, you can invest in that through an ETF like DIA. Again, this is created by Spider, SPDR, an institution that creates these types of ETFs. This way now, instead of trying to go out and find the perfect company, you can just invest in a fund. But let's go a little bit deeper. Let's say for the purposes of this example that you want to create cash flow, you want to create a new income stream that you don't have to worry about all the time. Are there funds that can give you exposure to that type of cash flow? Yes, I'm going to go over a few examples. NOBL, VYM, SCHD. By the way, the reason why these have asterisks next to them is because I personally have money invested into them myself. Starting with Noble, NOBL. This is an ETF that gives you exposure to dividend aristocrats that are in the S&P 500. This is going to get a little bit technical, but let me explain what this means. Number one, this is investing in dividend-paying companies that are in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Out of these 500 companies, some of them are going to pay dividends, some of them are not. This is investing in the dividend-paying companies. But it gets a little bit more sophisticated because it doesn't just invest in every dividend-paying company in the S&P 500, it invests in the dividend aristocrats in the S&P 500. A dividend aristocrat is a company that has been paying and increased their dividend every year for the last 25 years at least. So this is investing in companies that have paid out and increased their dividend every year for at least the last 25 years that are also one of the 500 largest companies in the stock market. That's what this ETF gives you exposure to. Then you have VYM. This is another ETF created by Vanguard, which is a high dividend yielding ETF. If you want to invest in broader companies that are paying out the higher yield dividends, this is an ETF that gives you exposure to that. A similar type competitor to that is SCHD. This is an ETF created by Charles Schwab. Again, focus on investing in dividend paying companies inside of the United States. So if you're looking to invest in companies inside of the United States that are paying out dividends, here are a few examples to start your research. Not telling you what to invest in, giving you examples. But let's go a little bit deeper now. What if you want to invest in companies outside of the United States? Is that possible? Again, I have a few examples for you here. By the way, if you're looking for an easy way to stay up to date on what is happening in the markets, when it's happening, I created a free resource called Market Briefs. It's a free newsletter that my team writes every day, which breaks down what's happening in things like the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. I promise you are going to love Market Briefs. And if you say, well, Jaspreet, how can you promise that? Well, if you don't love it, you can unsubscribe at any time because it's completely free. So if you want to join Market Briefs, I got the link for you to join down in the description below, where you can go to briefs.co/market. Now, when we talk about international companies, here are a few examples. MCHI, this is an ETF that will give you exposure to Chinese companies. INDA, you want to guess where that gives you exposure to? You got it. This will give you exposure to Indian companies. EEM is an ETF that will give you exposure to emerging market companies. This obviously has a little bit more risk, but more potential upside. And this is where now you want to think about what is your strategy? What is your goal? For me, and I don't recommend what I do to anybody else, my goal is cash flow. That is the bulk of my investments. When I invest in real estate, which is the #1 largest passive investment that I have, real estate is for cash flow purposes. When I invest in the stock market, the bulk of my passive investing are for cash flow purposes. Now, I do invest in some stocks, not for cash flow. I do invest in startups, not for cash flow. I invest in a number of places, not for cash flow as well, but the majority of my investments are for cash flow purposes because that's what I like, that's what I understand, because if I put my money into this thing, it will then pay me for owning this thing and I don't have to sell my investments to get paid. I like that. So for me, cash flow is something that I like to invest in, but you need to know what is your goal. If your goal is growth, if your goal is value, if you want to get exposure to emerging markets or to international companies, once you know what your goal is, then you can build a strategy. Just understand that if you're investing into these types of funds, the way that you build wealth is not by investing your money 1 time or 2 times. It's by building a passive investment system where every week, or every 2 weeks, or every month at least, you're investing your money into these things, and you do that whether the market's up, whether the market's down, and you set it and forget it. That was an automatic investment system. If you're looking for a platform that can help you with that, you can check out some of our advertisements down in the description. Now, there's one more part to your investment strategy that many people often overlook. We talked about now being financially prepared. This is the first thing we talked about, which is having money to invest. The second part to your financial strategy is having the financial education. Knowing how to analyze your investments. We talked about investing in ETFs versus index funds versus mutual funds. I know we kind of glanced over it all, but you get the idea. You have to know what it is that you're investing in. The third piece of this triangle that you have to understand that many people overlook is paying attention to the financial trends. I'm not talking about the financial news. You want to pay attention to the financial news, but don't let the news dictate your decisions. You want to pay more attention to the financial trends. This is a shift in spending habits, a shift in where money is flowing. That's what you want to be looking for as an investor. It's easy to understand the trends when we're talking about real estate investing because a trend is people are moving into a new neighborhood. People are moving into a new city. That can create a good investment opportunity because now you want to invest where the money is going into. With the stock market, it's the same thing. You want to look for industries and areas where the money is flowing into. What are new trends that people are now starting to spend more money on, either because people are more interested in this thing now, there's some new innovation happening in this industry now, there's some new regulations changing, which are making it more of an attractive investment now, or there's more money, there's more angel dollars, more investment dollars, more venture capital dollars flowing into these industries now. That's what you want to pay attention to when it comes to financial trends because you want to look for where the money is going into, because you want to go into an area that is going to be growing in 10 years, not dying in 10 years. Now, if you want to learn more about how to find these trends, again, Market Briefs will give you the financial news. We also have a Market Briefs Pro newsletter. It's a paid newsletter for people that are looking for financial trends. But for all intents and purposes, start with Market Briefs. It's free. If you like it, then you can consider trying out Market Briefs Pro if that is something that you're interested in. This is a very rough chart of what the stock market has looked like over the last 100 years. Over the last 100 years, we've seen big stock market crashes. We saw things like the 2020 crash. I know this is just a simple sketch that I did, but we had the 2020 crash. We had the 2008 crash. We had the 2000 dot-com bubble bursting. We had, don't forget, the Great Depression. I mean, we had a number of crashes that we've had over the last 100 years. But despite the market crashes, despite the recessions, the stock market has gone up. It just didn't go up linearly. And the reason why so many people say that the stock market is scammed, the stock market is rigged, is because they buy here. They buy when all you hear on the news is everybody is making money. And people are making so much money, they're getting rich that your taxi driver is retiring and they're living in Hawaii because of their stock market portfolio. So that's when people come in and then things start to go down. Now you start to panic, you sell. Maybe you bought on margin because everybody says if you just use debt, you can buy so much more stuff and get even richer. And now you end up selling here, you lose money, you think it's all a scam, it's rigged, all those things happen. Then you hear about people getting arrested and a lot of bad things happen on the way down. That's when you hear about all the fraud and the corruption. Well, the reality is, despite all that, the markets have gone up. It just doesn't go up linearly. So what you need to understand now is that these ups and downs are a part of the economic system. And the wealthy, the financially savvy, what they understand is that these create buying opportunities. Because now you could come in and buy great investments at a discounted price. When the 2020 crash happened, the financially savvy were buying stocks for 30% off because in a matter of days, the stock market fell by 30%. When the 2008 crash happened, the financially savvy were buying real estate for pennies on the dollar, while everybody else was losing. When the 2000 dot-com bubble burst, everybody was selling, but the financially savvy were coming in and buying for pennies on the dollar. Again, you got to be financially prepared. You got to have money to invest. You got to have the financial education to analyze your investments, but you also need to pay attention to what's happening because these things can create opportunities. And now you have to know your strategy and blend the strategy with the markets. If you were just dollar cost averaging, you're just investing every week, every 2 weeks, or every month. That's what that's called. You're investing into these funds and you're doing it on a passive and automatic system. That's called dollar cost averaging. The only thing you change is when markets go down, you buy more. That's the only thing you change. You don't turn it off. Because what the majority of people do, what you don't want to do, is when you see these downturns, people start selling out of their 401ks, they start selling out of their lifetime retirement accounts. That's not what you want to be doing. You want to use this as an opportunity to buy even more, not to panic sell. So you got to be able to stay calm, which brings me to number 5 now. How do you scale your wealth? There are 3 factors that will determine how wealthy you will become. TRM. T is time, R is return, and M is money, how much money you invest. The one factor that we cannot control is how much more time that we have. And so everybody will say, I wish I would have started investing 10 years ago, 20 years ago, 30 years ago, which is fine. We cannot change that. So you cannot change the time besides the fact that you can start investing sooner rather than later. The next 2 factors you have more control over is the return and how much money you invest. These 2 factors will determine how wealthy you will become, which means if you want to become wealthier, you want to get a higher rate of return and you want to potentially invest more money. How can you invest more money? Well, you can spend less or you can work to earn more. Pretty simple, right? But there are strategies on how you can spend less money. There are ways to find some extra dollars that you can squeeze out of your budget that doesn't really cost much on your day-to-day life. There are apps out there that can help cut out subscriptions. Go through your bills. See if you can negotiate some of your utility costs lower. If your internet bill keeps getting more expensive year after year, if your phone bill keeps getting expensive year after year, call them. Ask them to negotiate. There are ways to cut your bills lower and get the same service. That way you have some extra money without sacrificing anything. Maybe cut down your car, cut down your home, cut down the vacations. There are sacrifices that you can make. Maybe you work to get a second job. Maybe you work to get a third job. Maybe you work to start a side hustle. Maybe you work to start a business. The whole idea here is you're making more money so you have more money to invest. But you can also work to increase your returns. And there are 2 things that you can do here. Number 1 is you can work to increase your returns by increasing your financial education. That might mean now looking for a little bit more sophisticated investments. investing in individual companies, if that's something you're interested in doing, learning how to read financial statements, learning how to read an income statement, a balance sheet, a cash flow statement, studying the companies, investing in your own education. But this could also mean cutting down some of the fees that you're investing in. If you invest in a 401k, did you know that your 401k has a fee? If you didn't, I hate to be the bearer of bad news, but about 90% of Americans don't know that the 401k has a fee. So what I want you to do is go to your 401k, see what funds that you're investing in, and then look at the expense ratio. That expense ratio is the fee that you're going to pay on your fund. The next thing that I want you to do is see, are there funds that can get you similar returns that have lower potential fees? Because the lower fees could end up saving you a lot of money. For example, do you know how much a little 1% fee is going to cost you over the course of your investing career? It could end up costing you about $250,000, assuming that you make a median income. Why? Because a 1% fee isn't a 1% fee that you pay today. It's a 1% fee that you pay on every dollar that you invest, for every year that your money is invested, and every dollar that your money makes for the course of your investment career. So if you were going to have $1 million in your investment portfolio, that 1% fee could eat up between 20 to 28% of that, $250,000 going straight to your money manager in the course of fees with a small 1% fee. So what I'd like you to do as your homework for this video is go play around with an expense ratio calculator. They're all over Google. Just Google expense ratio calculator, find that. Then open up your 401k account, see what your expense ratio is, and now take that expense ratio number and plug it in. Then look at the different opportunities that you have to invest in with your 401k, and maybe you can find a fund that will give you a similar return, maybe even a higher return with a lower expense ratio. Of course, nothing is guaranteed. You may want to consult with a financial advisor if you want some specific guidance, but these are things I want you to think about, because now if you want to build wealth, it's TRM, time return money. You can't change the time. You can improve your returns by investing more aggressively or potentially cutting your returns, or you can work to invest more money. These are the things you want to think about as an investor. That way you can actually build wealth, because we have seen the markets grow by around 10% a year for the last century. We know that over the long term markets grow. We know that there are market crashes. We know that there are opportunities. But the people that are just chasing the next hot stock often end up losing. But if you stop doing the attractive thing and start doing the boring thing, it is a proven way to build wealth over the course of your career and not really have to take on much stress if you just let the markets do their thing and let the economy do its thing. Sure, you got a 600% increase in incomes over the last 50 years, but the prices of things that you need have gone up significantly faster than that. Back in 1971, the median household income was based off of one person's income. In 2023, most households were a 2-income household. So you double the number of people working, but most people still aren't able to keep up with the price growth of things.